Hi, in this episode, we are going to dig into why infinite banking is not a good idea and why you shouldn't do it. Hi, everyone. Welcome to Control and Compound with Darren Mitchell. I'm your host, and joining me today is Christina White. Christina, how are you today?
Hey Darren, I'm doing pretty good. How are you doing today?
I'm doing great. So we're going to explain today why infinite banking is a scam and no good, rotten, horrible product that you shouldn't put your money in.
Absolutely. But before we get started though, I do want to remind everybody that if you're listening on your favorite podcast platform, you're going to want to subscribe and leave that 5-star review. And if you're listening or watching on YouTube, make sure you like, subscribe, and hit the bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound to learn more about infinite banking.
Thank you. So, why infinite banking is not a great idea. So, for those of you that have listened to our other podcasts, you may sense this is a bit of a change of heart. Well, it's not really a change of heart. What Christina and I wanted to do in this episode is what were we saying earlier? Haters gonna hate, right? So you get when it's just like when someone becomes successful or prominent, people like to knock them down. It's the same as infinite banking, right? Infinite banking is just a surge in North America because in times of uncertainty, people want certainty. So you get a lot of people now coming out just crapping on whole life. And you know, I'm not going to crap on the individual advisors or people doing that because some guys are even up front. Oh, no, I'm just crapping on it because it's so popular. I know there's some people that, you know, don't like it, and then therefore I'll get them as clients. But what we wanted to do in this episode is go through some of the things that people say about whole life or infinite banking to make it, oh, it's a scam, don't do it. You know, the banks are wrong, the insurance companies are wrong, the wealthy people are wrong, everyone's wrong. It's a scam. So, Christina, where do you want to start on that? Is that basically summary what we're going to do? Is that
Yeah,
fair?
exactly. So there's just a lot of non-truths out there as well.
Yes.
So I'm okay. Everybody has an opinion. I completely get that. And you can hate it and say you hate it. But if you're going to speak about it, at least know your facts when we're talking about it, right? Like I don't like untruths out there, and not just, we want to make sure that you have the real information, and here it is. That's why we're saying, everything has upsides, downsides, and we do talk about both when we talk about infinite banking and who it's for and whatnot, and different things that have happened in the past with whole life policies and those types of things. And that's what we're going to talk about. We want to clear it up, and we want to make sure that the real facts are out there for individuals, and not conspiracy theories, I guess. I don't know what you'd call them, whatever. We're going to get the real facts. And we actually took the time to make sure, because some of these things that are thrown out are from a long time, like a while ago. And we wanted to make sure, okay, we have all the actual facts? And we went and sat down with some individuals to gather these facts for you, because we want to make sure that people make informed decisions. So I know today we met with someone at one of the big 4 companies that we deal with to talk about vanishing premiums. That's a big one. That is a big one that we're hearing a lot more about, and how participating whole life was sold in the past, and it was sold as a vanishing premium. And we want to kind of get to the bottom of that and chat about it.
Yeah, absolutely. And you know, and again, in fairness to some of these comments, sometimes there's a glimmer of truth,
Okay.
and it's like a glimmer of truth in some of the things. Some things are just total crap, but some things there's a glimmer of truth, and people are like, oh, well, that's true, but everything else they said isn't. So let's talk about the 1980s. So I'll give a quick recap because I was alive in the 1980s. So I was older in the 1980s than you. Let's say that. So 1980s. So what happened in the 1980s? Well, it was the heyday of the stock market. It was the heyday of inflation, and it was the heyday of interest rates, and it was the heyday of whole life dividends. Everything was big in the 1980s. Rates were high. People were paying 18, 20, 22% on mortgages. GICs, interest rates were through the roof. Stock market was doing 15, 20% a year. And everyone said, hey, it's going to continue like this forever and ever and ever. Well, what happened in all kinds of industries, right? Stock market, they were assuming a 15% return for life. Real estate investors were assuming places are going to go up 15 and 20% a year for the next 50 years. Like, everyone got it wrong. But if we look back, really what happened in this vanishing premiums, the insurance companies' contracts weren't inaccurate, but the way it was sold, some of the advisors didn't necessarily disclose everything, okay? It was the wild time in the 1980s. The rules, the oversight, the compliance, that word compliance, if any of you have a business, you know that word compliance comes up hourly in our business. That stuff wasn't around. So what happened is dividends were really high just because interest rates were really high. Dividends, I don't know, 12% or that. So when they did these projections, they go, oh, well, instead of paying for, the next X amount of years, in 6 or 7 years, you're going to have so much cash in there that you never have to pay premiums again. Therefore, they vanish. Okay? Now, it's easy to look back and say, well, of course, interest rates weren't going to stay high at 15 and 20% like they were in the 1980s. But in the 1980s, people didn't think like that, because I don't remember in the last 15 years people saying, well, of course, interest rates aren't going to stay extremely low forever. They're going to go back up. We fell into that same trap of thinking interest rates were going to be low. So what happened? Dividend rates really high. 7 years went by. The premiums didn't vanish. Why? Because the dividends went down when interest rates went down, just like the stock market went down and just like inflation went down. So everything went down. So realistically, they're predicting a really high dividend. What they should have been doing is more of a middle of the road dividend in the future. Now, the opposite is happening the last 15 years is we had extreme low interest rates, and we're assuming no increase in dividend the last number of years we've been illustrating, when in reality, that's not fair too. Again, it'll probably be somewhere in the middle. So just like in the 80s, they were wrong, in the the 2000s, 2010s, and 20s, I think we're going to end up being low, but time will tell. But they're projections based upon information. But what are some of the big changes since the 1980s that this cannot or will not happen again, Christina?
Well, I think a lot of it comes from disclosure and getting more regulations and whatnot in place. So this vanishing premium that they call it is actually an offset. That's the name of it. So we talk about offsets with our clients all the time, and clients do use offsets. It's a very normal thing to do when we set up policies. And what an offset essentially is that we set up a policy with a set length of payments, either a 20 pay or sometimes it's a life pay. And if we want to stop those payments earlier because there's a large cash value accumulated there, we can do what's called an offset, and those cash values will pay the minimum premiums for you until it's fully paid up at that 20 years or life in some cases. That's an offset. So I don't even think that they were even using the right word. I think they were just saying vanishing premiums back then, not the word offset. Now, when we talk about offsets with clients, we always look, and inside the illustration as well, the insurance companies have added a sensitivity to it where you have to be able to run it at a -1. So you have to have a -1 dividend with our low dividends right now to show that that can be offset. And when you go to apply for an offset as well, there's, you're signing off on everything. There's disclaimers that say offsets are not contractual. And we talk a lot about things that are in the contract that are great. Offset's not in the contract, and it never has been. But these days too, with the lower dividends that we've seen and them increasing, I think we're in a much better place, like you said, than what they would have looked like previously. But we're still using that -1. So when we tell somebody that we can offset in 10 years, we mean that we can offset at a -1 dividend in 10 years. We're not, well, at least here, I don't know what other people are doing, but here, 100%, you are not getting told about an offset unless we're at a -1.
Yeah, I mean, there's been massive changes in the 1980s in three places. In oversight of advisors. No advisors getting away with that crap today. Like they'd be out of the business pretty quickly. Insurance companies are much more strict on that now, incredibly strict. And the federal government jumped in. OFSI and all these federal government agencies came in and said, no. This can never happen again. So, to be honest, it's almost a good thing that the insurance industry went through that in the 1980s, because anything that wasn't, full disclosure and wasn't set up properly, that's been fixed as far as we're concerned. That problem's not going to exist. And again, if we're ever in that high interest rate environment, next time, maybe not assume that interest rates will stay high forever and ever like people in the 1980s did. But anything else in the 1980s, Christina?
No, I think that pretty much covers it, Darren. The 80s, I think you're right. Everyone had it wrong. That's what the 80s were. Not just in insurance, everywhere, right? So it was a long time ago. Hopefully we learned from the experience there, and that's yeah. I think that's about all.
And I think, a lot of things. I look back at the clothes in the 1980s and the flipped up collars and the preppy look. I mean, we learned a lot of things that, we thought was cool back in the day that turned out not to be cool today. Okay, next, Christina. The other one we get a lot is there's no transparency. It's just a black box.
Yeah.
Well, is it a black box?
No, it's been called a black box, and I've heard that in our industry. People will refer to it as participating whole life is a black box, and this is where you have a little bit of a glimmer of a truth. It's not a black box. There's a couple things that we cannot calculate on paper, and that's because there's a lot more variables to it than just straight numbers. We're talking people dying, mortality, lapses, cancellations, expenses. There's a lot to it that doesn't have a specific number, which creates the effect that people say there's zero transparency. Well, that's bull. There's a lot of transparency in whole life. There's one piece that we can't calculate the actual numbers, and that's where this black box mentality is kind of coming from. But if we look at the things that are transparent, Darren, there's a lot of transparency around a lot of other things included in the whole life policy, right? Like we have guaranteed cash values. It's pretty transparent. We have a guaranteed death benefit. Our dividends are vested. At the end of the year, our cash values are our cash values. No matter what happens the following year, those aren't going anywhere. I would call that transparency, right? Like that is pretty solid transparency in my mind. I don't know how other people relay that, but lots of things are transparent. One thing is how the dividend is calculated. That is not, you can't sit down and calculate it. And it's true. You can't, right?
Yeah. People can't punch in a calculator and go, if I put in this much at this percent, how much am I going to have? You need an illustration. So yes, but you talk about transparency. It's like, okay, so you own a mutual fund that owns several other mutual funds. So combined, you might have 200 different companies you own in part of your mutual fund. Do you really know exactly what's going on company number 176 on their expense reports for their sales reps for the last quarter? Like how much transparency are you looking for? Like we've got a lot of transparency in the whole life, but there's so many moving parts with the actuarial calculations, life mortality tables, interest rates, growth, real estate prices, everything gets affected. So it's not a simple formula they can just give you and say, multiply by, 5.5% and there's your number. But we do have a 150-year track record. We do have an incredible amount of money going into it from the banks, the wealthy, the real estate investors. Like 150 years of doing this, we have a pretty strong track record of transparency as far as returns go about each individual year, how exactly they calculate the dividend. Sure, that's, there's a bit of a trust in the insurance company, just like there's a trust when I invest with a mutual fund.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
Exactly. And I think that the other piece of transparency is the funds. A large portion of the dividend does come from the investment returns. And people don't like the fact that they can't pick their own funds. But that doesn't mean that it's not transparent. Just because you can't pick the funds doesn't mean that they're not being transparent. We do have reports every year that break down exactly where they are invested and where those returns are coming from, what they've been, which just like anybody else investing in the market would look at the historical facts and see what the market's going to look like later, right? It's the same kind of thing. You don't have a crystal ball anywhere. And yes, the returns are made up. I personally like the fact that someone that is better at picking funds is doing it for me. Like it's not a bad thing that you have someone that's done it very well for 150 years doing it for you, right? I don't know why that's bad. And I don't know why that's not transparent. They're still providing all the information. You're just not picking it. There's a big difference there, right?
Yeah, and I guess again back to that glimmer of truth. Maybe some advisors don't disclose the par fund makeup. Well, if you deal with control and compound, every first meeting we have, we break down. This is what the fund is. This how much in bonds. This how much in private lending. This how much in real estate. This how much in the stock market, and we give exact percentages on how the fund is invested. But you don't get to pick the fund like you do. And trust me, I've seen how individuals pick funds. For the most part, you don't want to be picking your own fund. And again, this isn't your shoot for the moon stuff where you're trying to pick the next Apple or Amazon. Okay, that's not for the money that's going into this participating whole life. The money you're going in here, you want it rock solid. You want it bulletproof, and what they invest in works. So if you want to pick your own investments, this isn't for you.
Yeah. And I think the other one too are fees, right? People say that the fees are not transparent. Again, if you've ever sat down with us, one of the first things that we cover are fees, like the fees, the management fees inside of one of these funds, our fees to our clients, our commissions, how we get paid, full transparency. Like if our clients can contest that these conversations are being had, not my fault if you're not doing that. Not my fault. Like that is a crappy advisor that you're working with. I don't know, but like you might want to find somebody else because that disclosure should be happening. It's part of the rules. It's part of the regulations. And these regulators we talk about that have gotten more involved are at some point maybe going to stop that advisor from having those conversations if they're not disclosing. That's compliance. And I'm the compliance officer here at Control and Compound, and I can guarantee you that they're disclosing. It's happening. It's getting signed by clients as well. Like those disclosures need to happen. So.
Or not, or if not, Christina's all over you at Control and Compound. So we know what happens if we don't stick to compliance officers' rules. Okay, what's next, Christina? One of the other scams out there is they try to show a comparison policy, and they structure the policy to say, if I could structure a policy to have no cash value or the smallest cash value possible, that no one that actually sells infinite banking would ever do. Even the people that sell infinite banking, I don't like. They always have deposit option in the, and again, there's not a lot of them, but they still have deposit option in there. And we see some guys like, oh, look at this XYZ company quote, the cash value is only going to be this much. And it's like, well, that's not designed for cash value. It's designed for death benefit. It's like apples and oranges. It would be like comparing real estate in the GTA to real estate in, I don't know, Inuvik, okay? Those aren't the same markets. They both may come up or the milk point may go down, but they're not going to work the same. So to compare one to the other is just not fair. And I think it's the same sometimes when they do apples to oranges comparisons. To show an illustration that's not designed for cash value to prove there's not a lot of cash value, it's just, that is smoke and mirrors. The thing that they accuse the whole life of the smoke and mirrors, they're doing the exact same thing by showing these on purpose, poorly designed policies that aren't designed to grow cash value. That's just not fair, accurate, or ethical in my mind.
No, and maybe to a point, maybe they've never been taught to design them correctly either, and they're out there and they're the ones that are causing these issues because they haven't, both of us are infinite banking practitioners, right? Like we've taken the course, you've taken the time to learn about it, know how to structure these. If you're following those methods of infinite banking that you need to be following, you are not putting a policy in place that doesn't have an additional deposit option or that's, cash value funded, like maximum funded, because that's part of it. So when people start showing these illustrations, it really just makes them look bad as well because you're not designing it correctly and you're designing it for commissions. Honestly, that's why you would be doing it that way. There'd be no other reason.
Oh, absolutely. If you don't have you're not designing it for cash value, which is fine. Sometimes death benefits needed in that case. I'm not crapping on every insurance advisor that sells death benefit, but if you're trying to build an infinite banking policy and you don't put in a deposit option, that's because you're trying to maximize your commission. So for someone to show that type of product, just again, to me is not fair and is trying to just use smoke and mirrors on the other side.
Yes. Although we do have smoke and mirrors on our side, which make us look bad as well, where you're hearing things, right? And I don't like that either when advisors are, smoke and mirrors to clients to sell an infinite banking policy and make it look better than it is, because that is also not okay in my books.
Yeah, 100%. So we're not saying no one that sells infinite banking doesn't use smoke and mirrors and say stuff that we don't agree with, okay? We're saying we don't say that, but I mean, like, if we look at, even just go back to term insurance, really something simple. Like our industry, every industry has this, but you go online to buy term insurance, you can get rock bottom, dirt cheap prices for the quote, because they're only giving you the number as if you're 1% of the population that qualifies for super elite. Well, you apply for it, and then they go, oh well, you didn't qualify for that rate. Here's your other rate, and that's their kind of smoke and mirrors to get you in the door, instead of being honest up front and saying, well, 90% of people fall into this rate. It's the same in infinite banking. You get some people, they get into, oh, you're going to recoup all your interest and buy your groceries and buy all your expenses with it, and it's going to be wonderful. Well, that's not what we do. Like we believe your infinite banking policy is perfectly designed for opportunities and emergencies, but opportunities is our focus. And if you can use it for opportunities, then we believe it's just an amazing product for the right person, okay? For the real estate investor, for the entrepreneur. What other smoke and mirrors comments would you have, Christina?
Yeah, just one specifically is that recapturing the interest you pay to the bank. People say that you are becoming your own bank because of the fact that you're recapturing interest. That is why you're the bank. That is not why you're the bank at all. And we would never tell anybody that that's why you're the bank. And that has nothing to do with you being the bank, actually. And we'll go to that in a second. But we're not recapturing the interest that you would have paid to the bank. That's not what's making you the bank. The bank is making you in control, right? You are in control so that you can go out and you can do those other opportunities. You can use the and asset. You can have your money working in more than one place at one time. We've done a podcast on how the banks make money. That's what I'm talking about. I want you working like a bank and having your money working in more than one place like a bank. Nothing to do with this interest. Like, what's the quote that I love? And I always mess it up with the interest quote that you say, Darren. What's that one?
Oh, well, just if you understand infinite banking, the numbers really don't matter. But if you don't understand infinite banking, the numbers really don't matter.
And that's the point. It's the interest and the recapturing the interest that has nothing to do with it. You're not. And I'm going to tell you straight up, you're not recapturing interest that would have been paid to the bank. We're still paying our interest back, using it for our opportunities, but we have our money working in multiple places at one time. We're working like a bank works. We're in control of our money like the bank's in control of our money. We're doing what the bank does. Very small portion of what the bank does is collect interest. Yes, they definitely do from a big picture side of things, but it's different, right?
Yeah. Like when we borrow money, the other thing is we're not borrowing our own money. That's another kind of scam. Some people say you're not borrowing your own money. Your money is staying inside the policy, compounding tax-free for the rest of your life. You are borrowing from the insurance company or the power fund. Okay. You are borrowing from the power fund. So could it benefit the power fund a little bit? Sure. Is that really recapturing it for you? No, we're not saying that. But you're using someone else's money. You're using your cash value as the leverage. Now your money's growing tax-free in the policy, and you're using the money you borrowed for an opportunity, and you're providing a death benefit. So we're multiplying money like a bank. I had someone the other day said, you're not really a bank if you do infinite banking. And I was like, okay, I wrote a book called Be the Bank. I didn't actually think we were actually going to create banks. It was like, I inferred act like a bank, but I guess I got to be more clear on the next one. It's like how to act like a bank. Like, again, we're not actually being the bank. We're not recouping the interest, but it's an incredible way to guaranteed borrow your money, grow your money inside the policy, outside the policy, and death benefit. Christina, the other one is I heard a guy talking about how these older policies don't pay dividends, or some of these older policies don't pay dividends. I've been in the business 30 years. I haven't seen one, but I'll give them the benefit of the doubt there. But when you see your statement today and it says XYZ company on it, we really don't know who, that could be through 3 or 4 different companies. Because what happened, all these smaller companies that got swallowed up by the bigger companies. So you had a lot of these smaller companies with old crappy whole life products. And then the bigger companies came in and started swallowing them up. And they said, okay, we're going to honor your contract. We're not going to put you in like the Manu, Sun, Canada Life, Equitable, power fund, but we're going to manage your power fund for you as per your contract with the old, Maritime Life or whatever your company was. So if that one doesn't work out and it happens to have the name of Sun, Manual, or Equitable on them, like you can't crap on them for a product from 40, 50 years ago that was sold by another company that doesn't exist. That's why I go back to the importance of, dealing with the four major companies that we deal with, dealing with companies with a 100+ year track record, dealing with the four of the largest companies, not just insurance companies, but companies in Canada that are going to be around for the foreseeable future. So, any other comments on the policies that don't pay a dividend? Have you ever seen one?
No, not so much. I've seen some older policies that are like combination whole lives and bonuses and UL. Like it was like these old policies that have a whole life component to them, but they're not pure participating whole life. And there's a lot of those out there, and I do run into them from time to time. One thing to note about this, though, that even though they're not receiving a dividend going forward, they're still receiving their guaranteed cash values 100%. They had built-in guarantees just like, these policies do, and their cash value is still going up. Also, those dividends that they received leading all the way up to when they might have stopped paying this dividend at this point in time is still in those policies. So they received some pretty big dividends in the early years based on what had happened. And what the other thing, after speaking to an individual today, is that their guarantees were actually priced with these larger interest rates. So their guarantees are actually higher than what you would see in a regular guarantee. Like they've got higher guarantees, and that's why they can't pay dividends, because their guarantees are already pretty high. So now they're looking at it and they're saying, okay, well, we've already got to give you this. We can't really give you any more because there's no surplus. And that is part of this, right? We know that that's what happens in a whole life, that there's a surplus that gets returned to us. Which is why it's tax-free and why we love it. That's how it works. But if you are already getting a lot in that guarantee, they can't give you any more, right? And it is, but again, these are old products that are coming not from our main four. They've been eaten up kind of by these main four. And it is hard when you're looking at some of these old ones to decipher them. I think there was like one guy kicking around that knew that old one we were talking about the other day, right? Like they're not around anymore. They're not easy to understand, and they're not really fully participating whole life either.
Yeah, I mean, they're not a product we would ever sell. We're going to stick to the four companies we use. But yeah, I mean, that's, again, the smoke and mirrors of saying they didn't get a dividend. Well, I don't think he mentioned that cash values automatically go up every year. It's like, didn't know a dividend. That's a good, spin on it, as opposed to saying, didn't get a dividend, but the cash value still went up, because the cash values will go up to match the death benefit by age 100. And with the guarantees much higher back then, yeah, you're right. It's, if the dividend doesn't pay, they have the guarantee, and the guarantee was almost like the dividend size today. So again, older policies from 40, 50 years ago from a company that doesn't exist anymore. I can't make too many comments on it, but I haven't seen the same thing in my 30 years.
Yeah. What's another one? Infinite income. I have never told anybody that they're getting infinite income from these policies. Like, that's crazy. I wish that would be awesome if we had infinite income, Darren. Like, I didn't know we could do that.
I know. I hear some of these guys on the podcast or online and what they say, and I'm like, I don't know. Maybe do some people say that crazy crap to sell IBC? I don't know. I mean, I know the people that are authorized. I know basically every authorized practitioner in Canada, and I don't see that going on there. But Christina, like to wrap up here, I think what I struggle with is I don't believe infinite banking is for everyone. Okay, I believe it's for some people, and I believe it's incredible for a certain part of the population. So we don't go around saying everyone should have infinite banking. And that's where I got a real problem with when people go around and say no one should have infinite banking, because you really got to know your audience. As a financial advisor, I've dealt with a lot of, early in my career, people that didn't have a lot of money, and now we deal with a lot of people, some that still don't have money, some that have a little, and some that have an incredible amount of money. Okay, so we have that experience of seeing what people do. And when you're talking to somebody that is making 30 or 40 grand, working at a union with a stay-at-home spouse and 3 little kids at home, the advice that person needs is 100% maybe in line with what some of these other people are saying. I don't think that person should be having an infinite banking policy. I think that person should be getting some bunch of term insurance to look after stuff. But just like you can't take that advice you're giving the guy making 40 grand and then go apply that to a real estate investor or an entrepreneur or a wealthy individual. Like that is just absolutely, I don't know if it's craziness, inexperience, don't like that to me. What wealthy people want is they want to be in control of their money to take advantage of opportunities. They want to invest in themselves, a business, in real estate. So you've got to, as an advisor, structure that portfolio to say, all right, we need some rock solid guaranteed bulletproof money here, like cash value life insurance, that's not going to blow up, that we know we can access at any point. We know is going to grow tax-free for the rest of our life at any point. And we love debt. I heard one guy say he doesn't like debt. Well, again, if you're that guy making 30 grand a year with a spouse and kids at home, maybe debt's not your friend. But if you're a real estate investor in Toronto with 4 or 5 properties, debt is your friend. So I always struggle with people that are real estate investors and entrepreneurs and doing well, and then yet they want to deal with an advisor that's not a real estate investor, not an entrepreneur, and just starting out. It's like what the requirements financially for a real estate investor or a business owner or a wealthy individual are night and day different than a lower middle class individual.
Yeah. And if you sit down with someone and they say that you have to start with an RSP as a business owner or a real estate investor, that's your cue. That's your cue. It's not going to work for you. It's not going to work.
I would love to bring in like 20 of our clients, business owners and real estate investors, sit them around the room and say, oh, listen, we read this ebook or something. You should forget about the PAR until we all max out on our RSPs and you should get out of debt. Like, that we would be laughed out of the room and we wouldn't have those clients for very long. So again, just to sum up here, we're not crapping on any individual advisors out there. We acknowledge there's some people in the infinite banking policy that maybe go too far one way. And we're just saying there's also people out there knocking infinite banking that go too far the other way. We think it's an incredible product. That's why banks use it. That's why wealthy individuals use it. That's why over $1 billion goes into it a year in Canada. It's an incredible product for the right person, for that entrepreneur, for that real estate investor, for the upper middle class, upper income people. It is an amazing product. Don't be fooled by the smoke and mirrors. Infinite banking is wonderful for the right person. Thanks for watching. Thanks for listening. Have a great day.
What do you think?
Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.